Hello, this is Professor Hazara for the fourth video in the financial statement analysis ratios. And so this time I'm going to explain the fourth group of ratios. Just to recall very quickly, the first video had to do with inputs. They're all the inputs. And these are inputs which you can't really find very easily. So they could be on the internet, whatever. So I like to get them on the worksheet. Liquidity ratios, these ratios measure your ability to pay off short-term debt. Every company has to have some level of liquidity. Leverage ratios, these ratios are of interest to people, mostly the bond market, people who are going to lend the money for a long term, such as a 10-year bond or 20-year bond, and they want to know if you can pay back the interest and principal. And now these ratios are important to shareholders. Now, what are shareholders looking for? The shareholders are first of all, they want to know if the company is going to have a net income. Obviously, if you own shares in the company, you want to have positive earnings. So that's the first ratio, earnings per share, EPS. I just use the acronym EPS because it's so commonly used. The second two ratios have to do with the dividends you receive, because you buy shares for two things: growth and or dividends. Take your choice. It could be a mixture of both, or you're buying only for growth or only for dividends. Now, a company has to reinvest. A company is growing fast. It has to reinvest a lot of money into itself and may not pay a big dividend. But then if it succeeds in growing, then your share price grows along with it if it makes good investments in different types of projects. Now, there are some companies that they might grow slowly, but they pay a lot of dividends. And these are like consumer staples products, Procter and Gamble, that type of thing, Colgate, Palmolive. I think it's a separate company, type of company, the electric company, if there's still such a thing. But companies that they're usually called defensive companies. They usually don't go down too much of the recession because it's all products that everybody wants, regardless of whether the economy is doing well or not. So these two ratios measure um, dividends. So you've got earnings there, you've got dividends with these two ratios, and then you've got the price earnings ratio. And the PE ratio really is a very basic measure. Everybody talks about it, but it's got to be read very carefully. You got to take it in its context. And the PE ratio measures whether or not the market thinks that the price of the stock will go up. And basically, it's forward looking, whereas some of these other ratios are backward looking. Okay, let's start with earnings per share. Now, it shouldn't be too difficult here. Okay, so earnings per share. I'm going to go back to the income statement. I have an input on top for the number of shares, but I'm going to go back to the income statement just to make a point about earnings per share, which people tend to ignore. Earnings per share is, as you should guess, you've probably seen in maybe your basic accounting course, is just the earnings, the net income that the company earns for each common shareholder. Okay, and so it's going to be very important for me to emphasize that I'm going to do the calculation here, but earnings per share is always, 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 always shown on the face of the income statement. They do the calculation for you. So when you calculate this ratio, you should always confirm it with what you see on the income statement. It should be exact. Okay, we're going to do basic earnings per share. Okay, so let's go to the income statement, and we will get our earnings, our net income. There's net income for 2024, 93736. Okay, and yes, I am going to put a dollar sign here because this is a currency, obviously, dollars, where shares are not. Okay, and then we're going to divide by the number of shares. Where you get to the shares, they're on the face of the income statement. That you can't go wrong. You cannot go wrong because they've already, all the calculations have already been done by accountants. And now we look at this right here, and you see right there, shares used in computing earnings per share, right there. Okay, so we will use those shares. Okay, let's get the ratio. Okay. Well, looks a little low, but remember what I said. Remember what I said is that for Apple, this doesn't happen with most companies, but for Apple, because it is so huge, They've been cutting zeros off all their numbers, and the dollars are in millions and shares are in thousands. Since the dollars are millions are 1,000, what we can do is just multiply our result that we just got by 1,000, and that's true for in this situation when your shares and dollars are not in the same units. You have to consider that. Okay, so we're going to go back and we're just going to take this earnings per share way down. I'm going way down here, and our earnings per share, and multiply the result by 1,000. Make sure to put the parentheses around that. Okay, and multiply by 1,000, and you got $6.11. Okay, so I'm just going to say this is the net income per common share. It's common share. Common shares are the real shareholders. Okay, and keep in mind, I'm just going to put it here, multiplied ratio by 1,000, since dollars are in millions and shares are in thousands. Okay, now I want to emphasize this next point because everybody always forgets it. I don't know why. The result I got, you should be able to confirm that exactly by looking at the earnings per share that is calculated at the bottom of the income statement. The income statement, they do it for you. And they do it for you because earnings per share and growth in earnings per share are what ultimately drives stock price. So let's go back and take a look at the income statement. Okay, and there it is right there, $6.11. And basically what they just did exactly what we just did. They just took net income divided by the basic earnings per share right there, and they multiplied it because of the difference in units times 1,000. That's what they did. $6, they round up to $6.11. So you can always confirm earnings per share on the income statement. Now, earnings per share, besides being probably the most important number for shareholders, it's also important because it goes into at least two of the ratios that come after it. So that's what makes this easy. So dividend payout ratio. The dividend payout ratio measures what percentage of your earnings you're paying out as dividends. So let's go ahead and see. And that it just makes sense that if you have dividends per share, take dividends per share and divide that by earnings per share, we have the cash payment to each shareholder on top, the net income on the bottom. That's going to give us the percentage of earnings that are paid out as dividends. Okay, so I like this because earnings per share is right there. You don't have to worry about it. Once you confirmed earnings per share, it takes care of itself. Okay? And then dividends per share, if you don't recall, I did that up here because you had to get the dividends from the statement of cash flows. Well, I got the dividends per share right there. Okay, so dividends per share over earnings per share. Okay, and that's incorrect, by the way. Go back here. Dividends per share was actually 99 cents. What am I doing? Okay, or $1 is good enough. Okay, so let's get this right here. $1 divided by $6.11. So I'm going to put this, you can put this really in percentage terms. Just leave it as 0.16. That's good enough. It's not, you could do that, but I like to put it in percentage terms. About 16%. About 16%. Okay, I'm going to go ahead and just format these terms of dollars. And God, it's the 99 cents. Yeah, 99.3. And then this is definitely has to be formatted in terms of dollars. You're dividing dollars by dollars here. So currency, $6.11, that looks good. Okay, so this is saying that for every $1, for every $1 of earnings, Apple is paying out 16 cents, 16 cents as dividend. Okay, so if Apple makes $1 in earnings, they pay you 16 cents. Now, is that a lot or a little? I really don't know. That's why we use the next ratio, which really tells you a lot about what type of company Apple is. What is it, a dividend paying company or a growth company? Okay, so anyway, but this does tell you one thing is that for every they're paying out 16 cents on the dollar, and I'm just going to put here this means that Apple is keeping, let's say that's 16 cents, about 84 cents, 84 cents of every dollar it earns. 84 cents of every $1 it earns. So that tells you right there, that begins to tell you that Apple's a growth company because growth companies reinvest. They don't necessarily pay out a lot of dividends. So if you want to earn a dividend, if you want a slow moving stock that pays a lot of dividends, Apple is not the company for you. It still isn't. It pays a little bit more in dividends than it used to, like maybe 10 years ago, but still it's a growth company. And I hope it stays that way. Okay, I'm going to insert a little row here. Okay, now the next one is the dividend yield. And this ratio really tells you, it really tells you uh, whether or not you should buy Apple, literally pay cash for Apple stock for its dividends. Okay, and this ratio right here is on the top. You have dividends per share. It's calculated right there, 0.993. So dividends per share. Now you're going to divide that by the stock price. And this is why I inserted the stock price here. The share price at September 28th, 2024, I recall, is about $227. Okay. And this ratio, it's going to be a percentage, really, and a very low one at that. Okay. 0.00, it's not even 1%. That's not even 1%. I'm going to leave it that way just to emphasize how small it is. If I went on 4 decimal places, it would show you how small it is anyway. So I'm going to leave it like that. But this says that it's 0.4%. This says for every $1 that a shareholder invests in Apple, Apple returns I'm going to spell it out, 4/10 of 1%. It's not even 1%, 0.004, which is minuscule. I mean, you're not going to buy Apple. That's not even when interest rates are low. That's even below savings account interest rates when they're low. That's a tiny dividend, which means that, and this is all cash. Keep in mind that dividends are cash, and when you buy a share of stock, you're investing cash. This is your cash return. You compare this to interest rates. You could put 1%, $1 in the bank, and earn probably 3 to 4%. If you put $1 in Apple, you are earning less than you're earning 0.4 of 1%. So you're probably earning 10 times as much money by putting it in the bank on a cash basis. Of course, bank CDs and all those don't grow beyond the interest payment. They compound interest, but they don't have the growth potential that Apple does. So they're taking what you can see what's happening here is that Apple's paying out 16 cents for every dollar it earns, which is not very much, but it's keeping 84 cents of every dollar it earns in order to grow the company. And that results, since the stock price has grown so much, that has resulted in a cash return to investors of less than 1%. This is a growth company. You buy for the share appreciation. You do not buy the stock for the dividend. It's basically non-existent for what I'm saying. And the final ratio. And this is really a ratio which is it's sort of the interface between finance and accounting. And it's also, it has a loose interpretation, but you really, really, really need to interpret this ratio. So you have to look at the entire context of the ratio. Because sometimes it can mean one thing and sometimes it can mean another. It's a ratio you have to use in conjunction with a lot of other information. And this ratio is the PE ratio. And here's all my inputs. Here's the inputs again. Share price. Well, I know that I just got the share price from right there. There's your share price, and there's your earnings per share. So your earnings per share is $6.11. Okay, so your ratio here is 32, and I do not want to. I'm going to go ahead and make sure that these are formatted. Okay, earnings per share is obviously dollars. The PE ratio is really usually not interpreted in terms of dollars. It's usually labeled as times. Okay, so I'm going to take the dollar off that. So Apple has a ratio of 32 times. Okay, and usually I'm going to say Apple has a PE ratio of 32 times earnings. It's usually say earnings. So their price is 32 times their earnings. Now you can actually use forward looking. These are your historical earnings. They just, as a fact, you saw it in the income statement. They just made $6.11. A lot of times this ratio is calculated looking at forward estimates of earnings, which the analysts come up with. But we'll just stick with the usual. This, everybody looks at the P ratio. Starts here, okay. And um, how is this interpreted? Basically, a high P/E ratio is generally interpreted to mean that the company expects earnings per share, EP, EPS, and the stock price to grow rapidly. In general, a high PE ratio is better. Okay, now I'm going to put that all in there. And generally speaking, that is true. It's kind of the theory. If a company has high PE compared to its competitors, especially, let's say you have five companies, they're all in the same industry and pretty similar. The one with the highest PE is the one that's expected to grow. You always have to compare PE. You can't just compare share price. You have to normalize the share price by the earnings per share. Okay, so high PE generally means that the company is expected to grow fast. And this is a forward-looking ratio. Here's why. Stock prices are forward looking. This is from the stock market. The stock markets look forward. They don't care what you just did. They are concerned about what they expect company will do in the future. So that's a forward looking number. Earnings per share, we just saw it in the income statement, is historical. So you're comparing forward looking market expectations with a number which is historical, the stock's recent performance measured by through their earnings. So the more higher this gets, the higher this. So if the market thinks the company's stock is going to grow fast, they're going to drive the stock price up. These earnings are going to stay the same, and so as the higher the stock price goes, the higher that ratio goes. So loosely speaking, a high P ratio means the company's expected to grow fast. However, there's a couple of caveats. Be careful. Be careful. A high PE ratio can also mean that a stock is overvalued. That happens a lot of times. People, this stocks. Just think of a lot of companies. They're the latest thing, latest technology, AI, and all that, and their stocks explode. But at a certain point, the stock becomes overvalued because and you reach a point where you can only grow so fast, and the stock may be at the point where it's going to sort of take a little dip at least, or maybe the technology has become obsolete. The stock goes down over the long term. So you have to. So I'm going to say here. So evaluate the PE ratio within the entire context of the company's operating life. Yeah, I mean, so you would have to, you would really need to, when you look at a PE ratio, high PE ratio is good. It's better than low PE ratio. Maybe, but generally speaking, high PE ratio means there's some expected growth there. But look at the company too. Has it grown too fast? Has the stock outpriced itself? There's a lot of factors because you have to consider the industry. What's the industry average? All sorts of things. So be careful with P ratios. That's the general thing. And the reason is earnings are pretty much, they're not exact, but they're kind of, they're looking backwards and it's accounting information, and they can be volatile, but at the same time, that stock price is market information. And we all know that stock prices are not just impacted by um, earnings, they're impacted by macroeconomic factors like inflation and interest rates. Well, that's another reason that a stock could be undervalued. It's just going up with the market itself. So be careful with PE ratios. Anyway, that's my lecture on shareholder ratios. These are very interesting ratios, by the way, because these are the ones you should look at. So there's your earnings, these two are your dividends. This company does not pay a large dividend as an investment, as a return. And that PE is pretty high. I've seen Apple with bigger ones. And there are some companies with much higher ones. But, it's for companies which are really high flying and they're expected to grow. They usually pay low dividends because they're reinvesting everything. Okay. Anyway, that's my lecture on shareholder ratios. Have a good day.